Mr. Adejo.
Yes, sir. We can hear you, sir.
Good morning, sir.
Good morning, sir.
All right. The class we are having is a vision class. Our focus is to try and look at some topics, particularly those topics that were taken to financial management at the skills levels. These topics, although they were moved or they have been moved to financial management at the skills level. However, I can still have a right to text any of this topic at the professional level. I can decide to text any of this topic. One of these topics is portfolio theory and capital asset pricing model. One of the topics that has been moved to financial management is portfolio theory, capital assets, pricing model. If you look at last diet, a question was texted for 20 marks. Despite the fact that the topic has been taken to financial management. Now let's do a summary. What is portfolio theory really? What does this theory try to address? When we say portfolio, a portfolio is a basket of different investments. A portfolio is a collection of different investments. As a rational investor, you are not expected to place all your investments in one company. You are not expected to invest all your money in one company. You are expected to spread your investments. You are going to spread your investment fund across a number of securities, across a number of investment securities, in such a way as to minimize your risk and maximize your return. For example, look at Dangote groups. Under the Dangote groups, we have Dangote salt, one investment. Dangote sugar, another investment. Dangote petroleum, Dangote cement, Dangote food, Dangote flowers. What is Dangote trying to achieve? Dangote has created a portfolio of different investments in such a way that Dangote can minimize his risk and maximize its return. For example, if Dangote Cement is not generating enough profit, Dangote Petroleum can generate more profit. Dangote Sugar can generate more profit. Dangote Salt can generate more profit. Dangote understand the concept of portfolio. Do not place all your investments in one company. Spread your investments across a number of different investments. The objective, we call it portfolio diversification. Diversify your investment. The objective is to minimize your risk and maximize your return. Points to be noted. There are two aspects to investments. There are two aspects to investment. One is return, the other is risk. Okay, please, can you mute? There are two aspects to investment. One is return, the other is risk. As a rational investor, portfolio theory is teaching us. Portfolio theory is trying to explain to us that, look, don't place your investments in one company. Create a portfolio containing different investments in such a way that you can maximize return and minimize your risk. According to portfolio theory, there are two types of risk. We have systematic risk and unsystematic risk. What is systematic risk? These are risks that cannot be avoided. These are risks that cannot be diversified. These risks are unavoidable. Your systematic risk is so-called your beta risk. That beta factor, that beta is an index that measures the level of systematic risk. That beta factor that you normally use in your CAPM to calculate cost of equity. That beta is an index that measures the level of systematic risk. That risk that cannot be avoided. We now have unsystematic risk. Unsystematic risk, these are risks that can be avoided. These are risks that can be reduced. These are risks that can be eliminated. You can avoid this risk. You can reduce this risk. You can eliminate unsystematic risk. So there are two types of risk. Now, how do we measure risk? How do we calculate risk? You can calculate risk by using standard deviation. Your standard deviation can be used to calculate risk. We can also use, okay, let me try to explain this. We have investments, we have portfolio. When you say investments, that means just one. You invest your money in Zenith Bank. That is one investment. If you invest all your money in one company, that is investment. To calculate the risk of your investment, you are going to calculate standard deviation of returns. Your standard deviation is the square root of the variance. That is one. Now we now have portfolio. Moses, please, can you move? Now portfolio. A portfolio must contain at least 2 different investments. When you say a portfolio must contain at least 2 different investments. So when we say portfolio is a basket of different investments. Now, if you are asked to calculate portfolio risk, there is a formula for this also. There's a formula for this. Now you now calculate your risk. When we get to computation, return. Remember the explanation. There are 2 aspects to portfolio: return and risk. At times the examiner will give you the returns. Oh. Just 1 minute, please. At times, the examiner will give you the returns. At times, you might need to calculate the return yourself. Portfolio is calculated as the expected return of the portfolio. How do we do this? Probability multiplied by the possible returns. When we get to calculation, maybe we can use the formula if question allows us to do it. And lastly is you also have CAPM. That's CAPM. CAPM theory is a development of the portfolio theory. Your CAPM is developed from portfolio theory. CAPM is used to calculate required return based on the level of risk. The CAPM model, we use it to calculate required return. On the basis of the level of risk, the investment under the CAPM model, we only consider systematic risk. Under the CAPM model, we only consider systematic risk. risk that cannot be avoided. Under portfolio theory, we consider both systematic risk as well as unsystematic risk. For you to get to career, you only consider your level of systematic risk represented by the beta factor. That beta, at times you call it equity beta. We have equity beta, we have asset beta, we have debt beta. Systematic of P. Your equity beta, systematic risk of a GS company. Your asset beta is the systematic of an ungeared company. Your debt beta is risk of a company financed by debt only. Systematic risk of a company financed by debt capital. In reality, no company is financed by debt capital, 100%. You rarely see a company that is 100% financed by debt capital. Hence, your debt beta is usually assumed to be zero. Now the question is, assuming you are not giving the beta, how can you calculate your beta? Assuming the examiner did not give you the beta factor, the beta value, how can you calculate the beta value yourself? Because if you don't have the beta, then you cannot calculate cost of equity. Your cost of equity is returned to equity holder. That is required return. How can you calculate your beta? We have like 3 different formulas for calculating beta. I don't know if this question will allow me to reach it. You have like 3 different formulas for calculating beta. Let's go to question. We explain because this is a very long hours, but look at it. Review number 2. This question was together. And all of the finance on look at KPS and Let's go on with the class. It was a network glitch. All right, let's continue. KPSC, an all-equity finance multinational, is contemplating expansion into an overseas market. It is considering whether to invest directly in the country concerned by building a greenfield site factory, i.e., underdeveloped areas, typically outside a city, on agricultural land. The expected payoff from the project would depend on future states of the economy of the host country, as shown below. State of economy, economic state 1 or state 2, probability, and internal rate of return. Look at it. If the state of economy is 1, we can get internal rate of return of 10% with a probability of 0.6. If the state of economy is 2, we can get internal rate of return of 20% with a probability of 0.4. Look at this now. We are not certain. If you invest money in the foreign country, you can get 10% return with a probability of 0.6 or 20% return with a probability of 0.4. That means we are not certain. Let's continue. Case existing activities are expected to generate an overall return of 30% with a standard deviation of 14%. Let's explain that. Our current investments, our existing activities is expected to generate 30% return with a standard deviation of 14%. What it means is that our current activities, we can generate 30% returns, but there's a risk of 14%. Standard deviation of 14%. That standard deviation measures the risk. There is a 14% risk that we may not generate 30% returns. The correlation coefficient of K shares with that of the new project is negative 0.36. Let me explain that. What is correlation coefficient? Correlation coefficient. Correlation coefficient shows the degree of relationship between returns, between the returns in a portfolio. I will take that again. Correlation coefficient measures the extent of correlation or the extent of relationship between returns of the investment in a portfolio. Remember, A portfolio is a combination of different investments. For example, you invest part of your money in banking sector. Part of your money is also invested in telecommunication sector. That means you have created a portfolio of two different investments. In your portfolio, 50% of your money is invested in banking shares. The remaining 50% is invested in telecommunication shares. That means you have a portfolio containing two different investments. Now, when we say correlation coefficient, the extent of relationship between the returns of the investments in your portfolio. You can have positive correlation. You can have negative correlation. You can have zero correlation. Examiner says here, the correlation coefficient of K returns with that of the new project is negative 0.36. K returns have a correlation of 0.8 with return on the market. Why the new project has a correlation of negative 0.1 with Nigerian market portfolio? I can imagine how many students will prepare for this last diet. The beta coefficient for K is 1.2. The risk-free rate is 12%. The risk premium on Nigerian market portfolio is 15%. Assume K shares are correctly priced by the market. This question is portfolio theory. Are correctly priced. When examiner says the company shares are correctly priced by the market, that means expected return must equal to required. Go into it too deep. Let me not go too deep. Now, requirements A. Identify and discuss 5 major risks KPS is likely to face in undertaking a greenfield site investment in a foreign country. This was the last topic we did. Risk of international investments. Please, can you mute Isiaq? This was the last topic we treated. International capital budgeting. What are the risks If I place my investment in a foreign country, one, political risk. Let us take this quickly. One, you have political and legal risk. What are the political risks? There could be political crisis in the foreign country that will affect your investment. There could be, your investment may be nationalized. Nationalization of assets. The foreign country can decide to seize your investment under the policy of nationalization. There could be sudden changes in foreign investment policy of the country. You have placed investment in Ghana, or you place investment in South Africa. The government of South Africa introduced a new policy on foreign companies that will affect your investment. You also have economic risk. There could be exchange rate volatility, fluctuation in exchange rates. Let me expand this more. I will only read one and leave there. You can always read it yourself. There could be exchange rate volatility. That can affect your investment return. You can have currency inconvertibility. That is, you have invested your money, but you cannot repatriate your returns from the foreign country. You can have inflation risk. Inflation in a foreign country will affect your investment. You also have cultural risk. Cultural and human resource risk. Definitely. My company is based in Nigeria. My employees, they are based in Nigeria. We have our culture. We have organizational culture. We have our HR policy. No. We now open a subsidiary company in a foreign country. They have their own culture. They have their own language. It might be difficult for you to get required skilled labor for your work. Legal and regulatory compliance. The accounting or the compliance required in Nigeria. Differences in accounting, environmental, tax law. You might need to deal with this. Then you have operational risk. Please, you can go through this and pick any 5. Requirement B1. Estimate the expected return and standard deviation of the return for the new project. Now, we are going to use this opportunity to calculate how to calculate expected return and standard deviation of return from the new project. Let me copy this. Please just try to, we don't know what the examiner will text, so just try to master, at least have a good idea of it. Because it came to us as a shock last diet that ICAN is texting portfolio at professional levels. But what can we do? Now look at this. I'll pick my pen. To calculate expected return and risk, you have your probability. Probability? No. Okay, yes. Okay, probability. You have your, we call it possible returns. Possible returns. Then, assuming this is P, possible return. This is expected return column. This P bar, or let me use R. This is R, possible return, expected return. Then you have possible return minus expected return. Next column, possible return minus expected return square. The last column, probability multiplied by possible return minus expected return raised to power 2. This is the table required. Here we have probability of 0.6, probability of 0.4. Look at it here, please. (0.6, 0.4). Your internal rate of return, that is your possible return. You can either have 10% or 20%. Please, you don't need to put the percentage. We are aware that it's in percentage. This is 10. This is 20. Now, to get expected return, 0.6 multiplied by 10. This will give me 6. 0.4 multiplied by 20. Please, what do you have? My calculator is not here.
8.
I can't hear anybody.
8, sir.
8. More like that. Now sum up. 6 plus 8, 14. That is the expected return. The expected return from the new project, 14%. That is your Haruba, 14. Now, next column. To calculate standard deviation now. Deviation. Look at it, please. Your R, possible return, minus expected return. 10 minus 14, negative 4. 20 minus 14, 6. Now take the square. Minus 4 square. This is 16. 6 square. This is 36. The last column. Multiply by the probability. 0.6 multiplied by 16. What do you have, please?
9.6.
9.6. 0.4 multiplied by 36. What do you have?
14.4.
Now sum up. 9.6 plus 14.4. What do you have?
24. 24.
That 24 is your variance. 24. This is the variance. This 24 is your variance. Standard deviation is the square root of variance. Standard deviation is equal to square root of variance. My standard deviation is equal to square root of 24. What do you have, please? 4.9. That means for the new projects, expected return is 14%. Standard deviation is 4.9%. You are done with B Roma figure 1. If you are to interpret this, if you invest your money on this new project, your expected return is 14%, with a risk of 4.9%. If you are to interpret this to management, that if you invest money in the new project, our expected return is 14%, but there's an element of risk. Our risk is 4.9. The risk that we might not achieve 14%. You are done with B, Roma figure 1. B Roma figure 2. If the new project requires capital funding equal to 20% of the value of the existing asset of K, 25% of the value of the existing asset of K, determine the expected return. Please don't touch my screen. You can ask your question. Determine the expected return and the standard deviation of KPSC after the investment. This examiner, he deliberately brought this question to ICAN students. Now, let us try to analyze this. How do we go about this question? How do we go about this question, sir? Because you need to understand the question to be able to address the question. I want to calculate expected return and the standard deviation of return after the investment. After the new investment now. Now that means we have existing investments, we have new investments. So let's go to it together. I have existing, okay, let's do assumptions. Existing investments, represent it with X. New investments, represent it with Y. That means after the investment, now we now have to combine investments is equal to X, Y. Now let's go to it. I have to take this off. I have to shift you down first. I require space. I require this space, so I have to take you down. You can go down small here, come here first. Let me place it here. Now let's continue. All right. So I have X here, I have Y here. Expected return. The expected return and standard deviation. Standard Let me shorten this, please. Standard deviation. Examiner says, look at it to K existing activities are expected to generate an overall return of 30% with standard deviation of 14. I'll take that again. K existing activities are expected to generate an overall return of 30% with a standard deviation of 14%. I'll pick that. Our existing projects will generate return of 30%, standard deviation 14%. Our new investments will generate expected return 14, standard deviation 4.9. This is 14. This is 4.9. Please note, it is not compulsory to put percentage. We are aware that it's in percentage. But if you put it, no problem. Now, if you now combine these two projects, if you combine the new the two projects now, both your existing projects and your new project, examiner now asks you, what is the expected return after the project? After we now combine the two, that means our company, we have created a portfolio. We have existing projects. And we are planning a new project in foreign country. That means in our portfolio, we have two projects. We now need to get the probability now. Now look at this. Projects requires capital funding equal to the projects of the existing assets of KPS. You now need to calculate the probability. Look, our new projects. Now, let me do it like this. Existing new project is 25%. Sorry guys, it was a network glitch. Let me explain this again. Our new probability. The existing project S is 100%. Examiner say new projects is 25% of the existing projects. 25%. That means if I combine the two projects, I have 125%. Now, You now have to rework the probability now. Look at the rework. This is 100 over 125. This is 25 over 125. Now work this out. What do you have? The new project X 100 over 125. This will give you 0.8. This will give you 0.2. Look at it, please. You have gotten the probability. You can now calculate expected return after the new project. Look at it, please. The same thing we did. Expected return. Of the portfolio. When we say portfolio, you know why? We now have two investments. Our company now, we have existing investments, we have new investments. That means we have a portfolio now. What is the formula for calculating portfolio expected return? Please look at it, guys. Weights of X multiplied by expected return of X plus weight of Y multiplied by expected return of Y. What is the weight? The weight is the probability. For the existing project is represented with letter X. The weight is 80%. Probability of 0.8. The new project, the weight is 20%. Probability of 0.2. And come here. Expected return of new project 30. Expected return of existing project 30. Expected return of new project 14%. What is the expected return of the portfolio? That is after the investment. I'll come here. Weight of X 0.8. Expected return of X 30. Weight of Y 0.2. That is the probability of Y. Percentage probability multiplied by expected return of Y 14. Please work this out. This is the expected return after the new project.
26.8.
What do you have, please?
26.8.
This is 26.8. What you are saying is, if we invest in the new project, we now combine it with the existing project. Our company as a whole, our expected return is 26.8%. Now, remember, we have created a portfolio. We have diversified our investment. Part of our money is invested in the new projects. Part of our money is invested in the existing projects. %80 of our money is invested in the existing projects. 20% of our money is invested in the new project. You have created a portfolio. Now I want to calculate this one. Let's take water. Now,
Hello.
Now let's go on with the class. Sorry, I don't need to take water.
Ooh.
Now I want to get the standard deviation. Look at it. Determine the expected return. We have done this. And the standard deviation of K after the new progress. Now, please note how to calculate portfolio standard deviation. The formula is different, so look at it. Portfolio standard deviation. The formula is square roots open a bracket.
Oh, you have to both of you to the parlor now.
Please, can you mute your speaker?
Your things, when are you washing them?
Vincent, please, can you mute? Weight of X multiplied by standard deviation of X raised to power 2. Please, can this Vincent, can she mute her speaker? Thank you. Plus weight of Y multiplied by standard deviation of Y raised to power 2 plus 2 multiplied by weight of X multiplied by standard deviation of X multiplied by weight of Y multiplied by standard deviation of Y multiplied by half. This is the formula for calculating portfolio standard deviation. A portfolio containing two different investments. What we did here, this is a single investment. The new project only, one investment. This is the approach for one investment. But where you have a portfolio containing at least two investments, this is the formula you are going to use. Your WA, weight of X 0.8. Your QX, standard deviation of X, that is standard deviation of existing projects. Look at it here. 14. This is 14. Weight of Y. Weight of Y, probability of Y, 0.2. That is the percentage invested in Y. Your Y is the new investment. Standard deviation of the new project. Y, 4.9. We calculated it. Your last variable here, small letter R. This is the correlation coefficient. Correlation coefficients of existing investment return and new investments. That is what we are comparing. Look at it. Existing investments and new investments. Your correlation coefficient shows the extent of relationship between returns from the existing investments and the returns from the new investment. I can imagine how many students last diet will be able to figure out this, because in fact we didn't even do it. We didn't teach student portfolio last diet. We assume that it is meant for skills level. Now go back to the question. Look at this. The correlation coefficient of case return with the new project. That is K. K is the existing company. with the new project is negative 0.36. Please, just 1 minute. Sorry for the break. So please, guys, yes, we understand that a lot is required from this exam. We understand. We understand that a lot is required. Also, please try to look at your theories. What matters most is to pass the exam now. You now pick 0 minus 0.36. REA is equal to negative 0.36. Now go back to that formula. Please don't be disturbed. You might need to study it too. Examiner will not give you the formula. Just do like this, roots, brackets, 0.8 multiplied by 14 raised to power 2 plus 0.2 multiplied by 4.9 raised to power 2 plus 2 and now monitor it, multiply by 0.8 multiply by 14 multiply by 0.2 multiply by 4.9 then multiply by minus 0.36. Now apply your calculator. You are going to get final answer 10.88 or 89. Apply your calculator like this. Your final answer will be 10.89 or 88. Apply your calculator.
Yes, it's correct.
Somebody should confirm it.
It's correct. It's correct, sir.
If you don't know how to do it, you can take it individually.
It's
Do
correct.
the last one here. 2 multiplied by 0.8 multiplied by 14 multiplied by 0.2 multiplied by 4.9 multiplied by minus this. You are going to get minus. Now do this individual. This plus minus this. Find the square root. You have gotten the standard deviation of the portfolio. A portfolio containing existing investments and the new investment. The way you calculate standard deviation for individual investment is different from the way you calculate standard deviation for portfolio. If you do a summary now, although you are not have to do a summary, if you do a summary of results, we have existing project X, new project Y, then 80% X. That is portfolio now. 80% X and 20% Y. This is what we call portfolio. Expected return here, 30%, 14%, 26.8%. Standard deviation in bracket risk, this is 14%. This is 4.9%. This is 10.89%. Let me explain this. If you invest all your money in existing projects, your expected return is 30%. Your risk is 14%. If you invest all your money in the new projects, your expected return is 14%. Your risk is 4.9%. Look at this. The lower the risk, the lower the return. The higher the risk, the higher the returns. If you create a portfolio containing existing investments and new investments, that portfolio construction, 80% of my money, I will invest it in the existing projects. 20%, I will invest in new projects. My expected return is 26.8. My risk is 10.89. The purpose of portfolio diversification is to reduce risk. The purpose of portfolio diversification, why are you creating different investments, is to find a way to minimize your risk. The logic is, don't place all your investments in one company. The logic is, do not place all your investments in a single company. All right. Let's move to the next question. Requirement 3. Effects. What effects of the new projects the adoption of the project have on the beta of K? If we invest our money in the new project, what is the impact on K's beta? Now ask yourself, what is beta? Beta is an index that measures the level of systematic risk. Currently, what is KPLC beta? Look at this, please. The beta coefficient for K is 1.20. That is with our existing activities, our existing projects, our beta is 1.20. That means the systematic risk of K is currently 1.2. Now, if we accept the new projects, what is the impact of accepting the new project on the beta of K? How do we deal with this? We need to recalculate the beta now. We need to recalculate this beta. Existing beta, look at it. Existing beta equal 1.2. Now, what is the formula for calculating beta? You actually have three. You can calculate your beta as Haru multiplied by standard deviation of security. Let me use X. Okay. Over standard deviation of the market. Your R is the correlation coefficient. Correlation coefficient. Your SQX, standard deviation of security. QM, standard deviation of market. Now, you have to know what to pick. You know, we have existing investment security. We have new investment security. Our existing investment security, the beta is 1.2. Our existing investment activity, the beta is 1.2. I will now go to it. Look at this. You have to be careful with this question. Now look at here. K returns has a correlation of 0.8 with the market. That means our company currently, our correlation with the market is 0.8. While the new project has correlation of minus 0.1 with the market. First, you need to resolve. Let me go back to this. Space the time again. Let me take this off here. Let me place this here. Oh, God. You come back to that. All right, back to my workings. I'll still require this space. Now I'm looking at this thing. Let me still do this once more. Now return here. Now, K existing shares, correlation with the market. Currently, our beta. Oh, my pen. The beta is currently 1.2. How? That is K shares, K returns with the market is 0.8. Standard deviation of K existing investments. Standard deviation of existing investments is 14. You can derive standard deviation of the market. We are not giving standard deviation of the market. And without getting that, you cannot recompute the beta of the new projects. We know the beta of the existing projects. Without getting standard deviation of the market, then you cannot compute beta of the existing project. You now do a walk back first. You do a walk back. 1.2 is equal to 0.8 multiplied by 14 divided by standard deviation of the market. What is standard deviation of the market? You do a cross multiply. 1.2 QM is equal to 0.8 multiplied by 14 divided by 1.2 divided by 1.2. Get standard deviation of the market. Please work this out. What do you have? I think 0.33. I hope I'm correct. $0.33.
No.
My calculator said. Is it correct?
No, sir.
Yes.
What do you
9.33.
have?
It's 9.33.
9.33.
9 points.
Yes.
Oh, forgive me. Oh, I have 9.33. 9.33. Wow. People should pass. So the intention is to just try and see how best. Okay. Now you have gotten standard deviation of the market. Yeah, that's correct. 9.3. You can now return. I want to get beta of the new project. Beta of new projects. Again, the formula again. We are going to take the formula again. Beta is how multiplied by standard deviation of security over standard deviation of the market. The R you are going to pick is correlation coefficient of the new project now. Go back to that question. Look at it. Coefficient of negative 0.10 with the Nigerian market. We are now going to pick information related to new projects. And the standard deviation of new projects, we calculated 4.9. Return here now. Thank you. The beta of the new project. Correlation coefficient of the new project, negative 0.10, multiplied by standard deviation of the new project, 4.9, divided by standard deviation of the market, 9.33. Work this out now. 0.1 negative, negative 0.1 multiplied by 4.9 divided by 9.33. What do we have?
Negative
Negative
0.05.
0.05. Negative. I have negative 0.0525. This is the beta of the new project. Final calculation. Beta of the combined projects. The beta of the combined projects. And please watch out for this in your cost of capital. Where you have diversification. beta of K is equal to our existing investment is represented with 80%. Beta of existing investment 1.2, we call it weighted average, plus our new investment is 0. Beta of new investment negative 0.0525. That will now give you combined beta of the company after the new project. 0.8 multiplied by 1.2, what is this? Plus, no, I need to close the bracket. It's not stop worrying me. Plus 0.2 multiplied by negative 0.0525.
0.9.
0.9495.
Approximately 0.95.
Oui.
0.95 approximately. This is beta of the company after the new project. After the new project, K beta is equal to 0.9495. If you like, leave it like this. Yes, 195. Your question?
Sir, please help me scroll up a bit. Just more.
I should go more?
No, it's okay. Thank you.
Now, what is the impact now? The new project has reduced the company risk. Please don't forget, beta is an index that measures the level of systematic risk that cannot be avoided. Before, the beta was 1.2. When we take our existing activities only, the beta was 1.2. Into foreign land, and we invest in the new project. Our combined beta is now 0.95. That means our risk has reduced. If you are to comment on this now, the new projects will reduce the beta of KPSC from 1.20 to 0.95. Of course, we can't say go and start reading new topic. But if there's a way for some of us that we pass through skills at the skills level, last diet, I'm sure you want treated portfolio theory. You can run through your notes to refresh your knowledge. What we are trying to do is, nobody can say what the examiner will test 100%. We can only do a bit of permutation combination. Yes, your number one question, merger and acquisition, business valuation, cost of capital, investment, of course, most likely. Examiner can put portfolio theory to investment because portfolio is talking about investment analysis, return on risk. The last aspect, explain why an asset may have a negative beta. Why will your risk be negative? Why would the risk, or why would the beta be negative? If you are trying to avoid risk, you can have negative beta. Flight to safety. During market downtime, investor can shift capital from risky assets to a safe asset like government investment. Remember 2004, Nigerians, was it 2004 before 2004, Nigerian stock market has a crisis. Investors can put their money to government bonds. Flight to safety. Number two, counter-cyclical nature. That is the cyclical nature of the business. At a point where the economy is weak, you want to place your investment in a place that is very safe. You want to minimize your risk. What you mean by negative beta is that you don't want to take any risk. For an average risk-averse investor, they put their money in governments. They are very sure that government will not collapse. When we have the 2008 financial crisis in US, many companies suffered it, but government still remains. Low default risk investments compared to shares or stocks. When investors are interested in investing their money in this, you might read any of this to get yourself acquainted with why beta may be negative. All right. So the first question we're able to solve is on portfolio theory. I just hope that even if it is texted. Examiner didn't go far. There's what we call alpha value. We call it the alpha value. Your alpha value, where the expected return is not equal to required return. Please note that your CAPM formula. Let me put it here. This formula you are used to. This CAPM formula, RUX is equal to RUF plus beta bracket RUM minus RUF. This formula is used to calculate required return. The return you require based on your level of risk. This formula is used to calculate required return based on level of systematic risk. Your systematic risk is your beta. All right. Any question? Any clarification?
Hello, sir.
Yes.
Morning, sir. Yes, sir. First of all, I want to say a big thank you to you for this effort and for your taking it upon yourself at this very time to, even though after finishing the syllabus, you took it upon yourself to come and see us through. We really appreciate. Then I want to say that the capital market line, or is it the stock market line they call it, that we saw in the Golden Book, can you help us explain how it is used, sir, and the meaning?
What you are asking me? Okay, let me try. I'm also trying to touch other topics, but let me not throw away your question. But for you to get it more, to get it more, please permit me in just 1 minute. Let me bring in a similar question to what you are asking. Please just hold on, because I don't know how we are. Maybe subsequently, God will pass you guys. Maybe subsequently, we might need to bring back this topic. But we are battling with time. The time is to cover it is a challenge. Please just 1 minute. I actually thought of this, but because of this time, I don't know how far we can go with this. Otherwise, we should not only revise portfolio. Normally, we don't do class closer to exam like this. I've never done it before. I've never done class in May. Exam is just like today is 9. So like 9 days to exam. I don't do it. But the circumstances we find ourselves calls for this. All right. I will be placing. I will be placing a question here. It wasn't in the study pack before. It wasn't in the material before. But based on this request, I want to use this thing to explain more. We never can tell. Okay. Also, let me put Let me put one more thing. Because if examiner can text it, and I'm sure most of them will avoid this question. Because what you don't prepare for, they might just try to ignore the question. Okay? Now let me answer your question. Capital market line and security market line. Your capital market line is a representation of the portfolio theory. Your capital market line is a representation of your portfolio theory. If you look at your screen, there's a question I've added to it. If you look at your screen, that capital market line is a line that shows expected return of efficient portfolios as a function of volatility measured by standard deviation of returns. That capital market line is a line that shows relationship between expected return of efficient portfolio and the risk as measured by the standard deviation of returns. Now let me break it down. Your capital market line can only accommodate a portfolio. It cannot accommodate individual investments. What is a portfolio? A portfolio is a basket of different investments. It is different from investment. If I invest all my money in MTN shares, I have not created a portfolio. I have only gotten an investment. For me to create a portfolio, I must have at least 2 different investments in different companies. So your capital market line can only accommodate a portfolio, and that portfolio must be efficient. Then that portfolio is a function of volatilities measured by standard deviation. When we say portfolio, you consider the total risk. Your total risk is systematic risk and unsystematic risk. That will happen with the capital market line. Now, when you get to security market line, your security market line is a representation of the CAPM theory. Under CAPM, we disregard unsystematic risk. We only consider systematic risk. Under the CAPM model, you are going to assume that unsystematic risk has been eliminated. That risk can be avoided. So we have avoided that risk. So your security market line is a line that shows expected returns of individual securities as well as portfolio as a function of the beta factor. Now, please note, what is the difference between these two? What are the differences or the major difference? Portfolio can only accommodate, capital market line can only accommodate a portfolio. It cannot accommodate individual investment. Security market line can accommodate both individual investments and portfolio. Second difference, capital market line can only accommodate efficient portfolio. It cannot accommodate inefficient portfolio. Security market line can accommodate all portfolios and all investments, whether efficient or inefficient. You can now ask yourself, at what point do we say a portfolio is efficient? An efficient portfolio is that portfolio that maximizes your returns or minimizes your risk. An efficient portfolio is that portfolio that maximizes your return or minimizes your risk. Now let me run through this question. This is almost 10:30. I hope I can finish in 30 minutes. Now look at this. Let me expand this more. So it's not in your material, so you might need to look at what I have here. Oh, I have to take this off. Okay. Let me expand this more. Okay. Where's my water? Okay. Now look at this. Your investment firm is a major player in the Nigerian capital market. Following recent positive signs in the capital market, your firm has just recruited a number of young graduates. An in-house training program is being planned for the young trainees, and you are to facilitate on subject areas such as portfolio concept, capital asset pricing model, etc. Requirements A. Your managing director requires you to explain, without the use of graph, capital market line and the security market line. You are required to also highlight the differences between these two. Look at the response here. Capital market line, in bracket, CML, is the line that represents returns of the efficient portfolios as a function of volatilities measured by a standard deviation of their return. Security market line is the line which measures the expected returns of individual securities and portfolios, in brackets, efficient or inefficient, as a function of their sensitivity to market fluctuation. that is sensitivity to beta. The differences between these two lines lies in the fact that while capital market line represents only efficient portfolios, security market line represent all portfolios, as well as investments, as well as individual securities, either efficient or inefficient. Usman, are you there, please? This is the difference.
Thank you, sir. Yes, it's very clear to me, sir. Thanks.
Also note, this can be converted to calculation. There's a particular diet, I can't remember. Maybe 2020 diet. Something like this was tested in calculation. But again, you cannot, we are very close to exam. We cannot distort what you have been reading. So please, if you know that you have not read this topic before, don't go and start rushing to read it. Because whether it's going to be tested or not, we are not sure. If you don't know anything about it before, don't worry. Just the one you have read, God bless what we have done. But if you have an idea before, you are only doing a revision, that is good. Because it is not too good to bring in a new topic now, a week to exam. What you should be doing now is what I have read before. I'm just trying to do a revision to get myself ready for the exams. So we don't intend to distort your reading. The intent is to also find a way. If any of this topic is texted, at least you can contribute to a reasonable extent. All right. Now let me quickly go to the B part. Let me go to the B part. Now look at this. Part B of the question. The following data was sourced from an investment bank, OPIC Merchant Bank. You have 4 companies, A, B, C, D. You have forecast equity return. You have standard deviation of return. You have covariance with the market. Let me explain this. If you invest your money in company A, your expected return, that is forecast equity return, is 16.88. There's a risk of standard deviation, 6.3. We now have covariance of company A with the market, 32. We have for company B, if I invest my money, I can get 12%. The risk is 4.8. But there's a covariance with the market. The extent, what is covariance? The extent to which the return of my company will vary with the market return. Now, what is market really? Because some might say, what is this market is talking about? Let me try to explain this more. Assuming you are working in banking sector, you are working in a bank. Your bank is, say, Wema Bank. You work with Wema Bank. That Wema Bank is just one bank. We now have the banking market, the banking sector market. That market we are referring to is all the companies within the market now. We have insurance markets, we have banking markets, we have construction markets, we have telecommunication markets, we have manufacturing markets. All right? The next, the market return. and market standard deviation are 14.5 and 5% respectively. The risk-free rate is 6%. Returns and other data relate to 1 year. Requirement 1. Let me take that requirement 1. Requirement 1. 1B. Estimate the alpha beta. Estimate the alpha beta for each of these company shares and explain alpha. What is alpha beta? Your alpha beta is a measure of shares abnormal returns. Alpha value, the alpha value measure of shares abnormal return. Alpha value is calculated as the differences between expected return and the required return. Sorry for the break. Now, examiner says your what we call alpha value, the difference between your expected return and your required return. In most cases, the examiner will give you the expected return. So let's go to it. Please, can you mute Usman?
Okay, sorry, sir.
Let me quickly calculate this. B1. B1. Estimate alpha value. Your alpha value is equal to expected return minus required return. Examiner gave us the expected return. Look at it here. Forecast equity return. We now need to calculate required return. Now look at the working year. Required return is calculated as RUF plus beta bracket RUM minus RUF. Let me put it here. This is calculated as RUF plus beta bracket RUM minus RUF. If you go back to the question, we have risk-free rate, %6. Return on market, 14.5. Standard deviation of the market, 5. Our risk-free rate is 6%. Return on the market, 14.5%. The problem we have is beta. What we don't have is the beta. You are going to get required return for company A, company B, company C, company D. That means for me to resolve this problem, I must calculate my beta value. I will now come here. Calculation of beta value for individual companies. Which formula are we going to use? If you recall my explanation, we have 3 different formulas. The first question we solved, we use the second formula. The formula you are going to use is a function of the variables you are given. The first formula, beta is equal to covariance of security and market over variance of the market. Variance of the market. You can use this. Second formula, that was the one we used in the first question. The second formula, let me write it again. You can use beta is equal to R multiplied by standard deviation of security over standard deviation of the market. In this question, we have standard deviation of the market. We have standard deviation of security, but we don't have correlation coefficient. Look at this question very well. This is standard deviation of individual security. The standard deviation of the market, but I don't have correlation coefficient. I cannot use method 2. For this particular question, I cannot adopt this method. This method will go, but I can adopt method 1. I have covariance. Look at it. Covariance with market. Covariance of company A security with the market. I have it. 32%. Covariance of company B with the market. 19%. Covariance of company C with the market. 24%. Covariance of company D with the market. 43%. That means I can use covariance approach. And given the standard deviation of the market, 5%. I can do like this. Market standard, let me shorten it. Market standard deviation is 5. Please, how do we calculate standard deviation? I want market variance. Recall, standard deviation is equal to square root of variance. Examiner says standard deviation of the market is 5. What is the variance of the market? I have square root here. If I move square root out here, it becomes what? Hello? The mathematician in house. If I move square root over is equal to, it will give me what? Hello, I'm asking the class.
5 square.
Raised to power.
Thank you. This become 5 square. Variance. That means variance of the market is 25. That means 25 is equal to the variance of the market. Variance of the market. You have gotten your denominator. You can calculate your beta now. Beta for individual company. For company A. Company A. The covariance of company A, 32. Variance of the market, 5. Sorry, 25. Please divide. This is 1.2. 1.28. That is the beta of company A shares. Systematic risk of company A. For company B, the covariance is 19. Look at it here. Company B, covariance 19. Divided by 25. You have 0.76. That is the beta of company B. Systematic risk of company B. For company C, the covariance is 24. Divided by variance of the market, 25. Work this out. 0.96. For company D, the covariance is 34. Divided by the variance of the market, 25. This will give you 1.72. You have gotten beta, the beta value for individual companies now. You can now calculate required return using CAPM. Calculation of required return using CAPM. Required return is equal to RF plus beta bracket RM minus RF. For company A, the risk-free rate is 6. That will not change. Regardless of the company, risk-free rate is the same. What is the beta of company A? 1.28. Return on market, that is also the same, 14.5. Regardless of the company, return on market is constant. Minus the risk-free rate, 6. Work this out. That will give you required return for company A. If you work this out correctly, you have 16.88. Go to company B. The risk-free rate of is still 6. What is the beta of company B? Look at it here, 0.76. This is 0.76. Bracket return on market, 14.5 minus 6. What do you have here? This should give you 12.46. Check it out, if I'm not mistaken. Go to company C. The only thing that will change is the beta. The level of risk, the level of systematic risk of individual companies. Risk-free rate, 6. Beta of company C, 0.96. Bracket 14.5 minus 6. What is the return here? 14.16. Check it out. This is company C. For company D, 6 plus the beta of company D, 1.72. Bracket 14.5 minus 6. What do you have here? 20.62. You have gotten required return based on the level of systematic risk of individual companies. One of the major determinants of returns is your level of risk. You can now calculate alpha value. You can now calculate alpha value. Let me copy this to make it faster. Let me put this here. Okay, why? No, don't copy like. No, the way copy is not good. Just 1 minute. I want to use it that same way. Better this way. I have the companies. This is expected return. Examiner, in most cases, examiner will give you the expected return. The expected return. The expected return. So we have this is required return. Required equity return. I'm trying to create space. This one will go. This will go. This will go. This will go. I will expand anything. Expand. 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 I don't need this. This is my alpha. Alpha value. You can go. You can go. You can go. You can go. There is the alpha value. Then you need your comments. Let me create space here. To the right. One more. To the right. Here we have remarks. Remarks. And questions. Bring in your calculation here. Required return for company A based on CAPM. This is 16.88, 12.46, 14.16, 20.60. Now compare. For company A, expected return is 16.88. Required return is also 16.88. The difference is 0 here. 12 minus 12.66, negative 0.46. 14 minus 14.16, negative 0.16. 21.5 minus 20.8. I have positive 0.62, Abby? Yeah, 62. 0.88. Your alpha value may be positive, negative, or 0. If the alpha is 0, it means your remark here, this investment is properly priced, properly priced. If your alpha value is negative, this investment is overpriced. 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 If your alpha value is positive, it means the investment is underpriced. This is underpriced. For company A shares, the action is hold. Hold on to your investment. Don't sell it. Don't buy more. That investment is properly valued. There's no distortion. For investment B and C, this investment is overpriced. It is too expensive. Actions to be taken: sell. Sell. When an investment has negative alpha, just sell those shares. If you don't sell it, that investment will crash. If you compute alpha value and you get negative, the appropriate action to take is to sell the investment. For investment D, the investment we are referring to is shares. The alpha is positive. Buy more. Buy more of these shares. You have calculated your alpha value. You can now comment. You can now comment on your computation. Let me copy the comments. So please, like I said, we don't intend to distort your reading. We only want to make sure that you are not caught unaware with some of these topics that has been moved to skills.
Hello, sir.
Yes, please.
Yes, sir. The point you made is noted. But I want to say that some of us that are here, we are not just here because we want to pass exam. Some of us, the exam is not even important to us, but we need the knowledge. That's why your effort is not. Yes, your effort is not misplaced. Sir?
Correct that statement. The exam is
No,
important.
some of us are not, and it's not that it's not important, but we are saying that some of us that are your students, it's not as if we so much want to just go and pass the exam and say we have passed the exam. Some of us is the knowledge that we really need. That's why you see that some of the questions we ask, it's not just about the exam, it's also about us knowing what we are doing presently, deeper.
I just want to
But I also need to ask, you also need to back up
I just want
with
to pass.
certificate. Clear understand?
Yes, sir.
When you are praying to God, you need to play your prayer very well. You need to pass this exam. Because even if you know this book very well, and you want to speak, you may not be able to speak in some group. And because if I know you, I can say speak. No in council said, if you want to speak, say, you will ask you to fight. If they look at your qualification days, they say you can't talk. Go and sit down first. If you go to that meeting, you now realize that guy, something can embarrass somebody. Somebody that qualified last year. So you want to say, who are you talking to? Better sit down there. They will even shout, Oga, go and sit down. Somebody told me that I qualified 20 years back. That means I can't be talking. Me that I've been my qualification has run for like 13 years. He said, no, I can't talk. That it's not my mate. So you also need the certificate. Is that clear, sir? Now your question now.
Yes, when we say return of the market, is it return of the equities market or the return of the overall stock market? I need that clarification, sir.
Let me say that market. I thought I even did it. Let me say return on the market portfolio. You have what we call individual market now. If you look at the banking market, it's different from construction markets. If you look at telecommunication market is different from manufacturing market. That return on market portfolio, all the quoted companies that operate at the stock market within the banking sector now, that is the market. Is it getting better?
Yes, from what you have said, I think you are talking about sector
Yes,
return on the market.
market
That's
sector
good.
return.
Okay. It's clear now, sir. It's clear. Yes.
If you find yourself in the stock market, you are going to do more of this. I'm going to say, please, so me, I want to pass. All right, let's comment and round up this. Look at the comment. Alpha value is a measurement of abnormal return. Shares abnormal return. It is the difference between expected return and the required return. Alpha could be positive, negative, or zero. If your alpha is positive, it means the investment security is above the security market line. Look at investment D. Investment D has a positive alpha, 0.88. Investment D is above the security market line. And this investment is possibly underpriced. Hence, more of such stock should be bought. If the alpha value is negative, it means the investment security is below the security market line. Look at investment B and C. We have negative alpha. This investment is possibly overpriced and should be sold. If the alpha value is zero, it means the security is properly priced and there's no incentive to buy more or to sell current holdings. Alpha value helps the financial manager to make, buy, hold, or sell decisions. You are done with that aspect of the question. Let me check out of this. The Bureau figure 2. Examiner says, briefly discuss the reasons for the existence of alpha values and whether or not the same alpha value will be expected to exist in 1 year time. Look at the response. Okay, look at it here. Let me just copy it. Wow. So after the class, of course, we share the material. But we share the material again, you can, like I said, please, as much as possible, while you are reading the new thing, please make effort not to distort what you have read before. So make effort not to distort what you have. This is a B2 now. B brackets. This is B2, yeah. So if you are going through it, look at the response. Look at the response. Positive or negative alpha values exist for shares. If the CAPM model is a realistic model, alpha values should only be temporary. And the same alpha value will not be expected to exist in 1 year's time. Please note, alpha value is a measure of temporary abnormal returns. The same alpha value is not expected to exist in 1 year time. Alpha value may exist because of inaccuracy or limitation of the CAPM. Why do we have alpha value? If you look at that requirement B2, there are 2 questions in one. Examiner says, explain why there's alpha value. What are the reasons why you have alpha value? Then, are you expecting alpha value to remain the same? The answer is no. Alpha value is not expected to exist in 1 year's time, the same alpha value. Alpha value may exist because of inaccuracy and or limitation of the CAPM. Inaccuracy in your market risk and return. Data inputs into the CAPM may be inaccurate. It is impossible to accurately calculate the market risk and the market return. That can give rise to differences between expected return and required return. And that will give rise to alpha value. Number 2 reasons. CAPM model is based on a number of unrealistic assumptions. The model we use to calculate required return is based on a number of unrealistic assumptions. One of the assumptions of CAPM is that only systematic risk determine returns. Based on CAPM model, the only factor that determine returns is your level of risk, your level of systematic risk. In reality, other factors, in addition to systematic risk, might influence required return. That assumption is wrong, and that can give rise to upper value. Next, CAPM is a single factor model. Only one factor determines return. And the factor is systematic risk. In reality, several factors will determine returns. That means we require a multi-factor model. Is it in your slab also? APM, arbitrage pricing model. Yes, it's in your slab also. A multi-factor model. APM, arbitrage pricing model. Arbitrage pricing model is an advancement of the CAPM model. The arbitrage pricing model uses several factors to calculate required return. Lastly, we have CAPM is a single period model. That's a big limitation. You can only use CAPM to evaluate investment for 1 year. A single period model. If I invest my money here now, what is the return I'm going to get in 1 year? That is when you can use CAPM. If you are dealing with a multi-period project, you can use CAPM. All right. We have talked more on CAPM. Any question? We are closing discussion on CAPM now. Any question?
Yes, sir. I wanted to say that we started with portfolio theory, and we are ending with CAPM. At this point now, sir, maybe in 2 minutes, can you just explain to us the efficient market hypothesis, what it means?
How we come under source of financing now? That topic you are asking. It's a topic under source of financing.
Okay. As a revision class, sir.
I can
just
explain. We can explain. But I'm just trying to tell you that thing you are asking.
Yes, sir.
Efficient market hypothesis is a topic or a subtopic under sources of financing. Now, okay, you know what we do? Let's go to it. Let me ask the class. As a finance manager or as finance manager, how can you finance your business? What are the methods of financing?
Through debt or through equity.
Great. You can finance your business either using equity finance or using debt financing. Now, if you use debt finance, What are the factors you are going to consider to get an appropriate financing? If you use equity, there's a cost attached. There's cost of equity. And there's the risk of equity financing. If you use debt, there's cost of debt. There's also the risk of debt finance. So how do we determine the appropriate finance for our business? What are the factors we are going to consider? Several factors will be considered. One of them also is capital market efficiency, which is the question Usman is asking us now. We consider several factors in finance. One of them is efficient market hypothesis. Now, what is efficient market hypothesis? We also call it capital market efficiency. It's a theory that assumes that the share price reflects all information about the company. Your efficient market hypothesis is an hypothesis or an assumption that the stock market price reflects all information about that company. Hence, the stock market price is the accurate value of the company, where the market is efficient. Where the market is efficient, whatever the share price at the stock market is the true value of the company. Where you have an efficient market, whatever the share price at the stock market, that is the correct value of a company. Your efficient market hypothesis assume that that capital market is efficient. In an efficient market, all investors, all market participants have access to the same amount of information. In an efficient market, nobody can take undue advantage of the market because we have access to the same amount of information. If the market is efficient, then there's no distortion. What are these distortions? Taxation is a distortion. Where the market is efficient, then we are going to assume that there is no taxation. Where the market is efficient, we are going to assume that there is no transaction cost. You can buy shares and sell shares without incurring transaction costs. It is not very easy to achieve an efficient market because information is not available to all investors. All investors do not have the same amount of information. Recall, we said efficient market hypothesis. The assumption is that information is not hoarded. All the investors have access to the same amount of information. We now have three types of efficient market hypothesis. We have weak form of efficient markets. You have semi-strong form of efficiency. Then you have strong form of efficiency. When we say weak form of market efficiency is a situation where the company share price only reflects past information. Weak form of efficiency. You have weak form of efficiency. If you are operating from the weak form, you are making investment decision with past information. The company share price reflected past financial information about the company. That is a weak form. You can never make a good decision if you are operating from weak form of efficiency. You are basing your investment decision on the company's past financial performance, past financial results. That is weak form. We have semi-strong. Semi-strong form of efficiency. For semi-strong, a situation where the company share price reflected past financial information as well as current financial information. A situation where the share price at the stock market reflected the past financial information as well as the current financial information. That is semi-strong form of efficiency. Then you now have strong form of efficiency. This is where company share price reflected past financial information, current financial information, as well as future expected information. This is the best position. where your investment decision considers past financial information, current financial information, as well as expected future information. Only privileged investors have access to future financial information. We call it privileged information or insider information. Remember, the investors, they don't work in the company. They don't know what the company is planning to do. They might not know 100% what the company wants to do in the future. Only selected few investors.
Is this something I should pray about? Walking through this process helps me to get to a point where I'm emotionally regulated.
Who is doing this to us? Please, can you mute? Please, can you mute? So we have explained efficient market hypothesis. If now want to source fund, should we issue shares to source fund? Or should we issue debt? If you finance the project with equity, what is the implication? If you finance the project with debt, what is the implication? What are the factors you are going to consider? To determine your choice for financing. One of the factors is to look at the company financial ratios. We have a new project. The new project will cost us 100 million. We are now debating, should we borrow to finance this project? Or should we finance the project with equity? Or should we do a combination of equity and debt? One of the factors you are going to also consider is to go and carry out financial ratio analysis. You want to look at it. What is the company's level of gearing? You are trying to determine the company level of financial risk. Because if you borrow more money, that will increase your financial risk. You also consider cost of fund. If I use equity, what is the cost of equity finance? If I use debt, what is the cost of debt financing? Generally, debt finance is cheaper than equity finance. Because your debt finance, you are going to enjoy tax relief on cost of debt. That will reduce your cost of borrowing. So you consider cost of fund. You also consider the risk involved. If you finance your business with debt, your level of financial risk will increase. If the business risk is high, that means the total risk of the company will be high. So if you are trying to minimize your risk, it is better to finance your business with equity, particularly if your business risk is high. We also consider cash flow availability. While we are discussing this, let's look at question. Which one should we look at, Seth? Look at this question. Question 3. While we are discussing this now, I said cash flow availability. If I'm going to borrow to finance my business, I must ask myself, do I have enough liquidity? Do I have enough cash flow? Because if I borrow to finance my business, I'm going to pay the interest annually, and I'm going to do the principal repayment. So you are going to ask yourself, if we finance this business with debt, do we have sufficient cash liquidity to meet annual interest payment? Because failure to meet your interest payments, if you fail to pay the interest, the bank or the lender reserve the right to force your company into liquidation. When you default on interest payments, bank can take over the company for you. So you are going to ask yourself, do you have sufficient liquidity? That means you must know how to calculate liquidity ratio. Next, you must also ask yourself, if I'm to finance my business with debt, in most cases, the lender may require collateral. You now ask yourself, do we have sufficient non-current assets that can be used as collateral for the loan? In most cases, loans are collateralized. You hardly see people giving you loan without a collateral. So you have to consider availability of non-current assets that we can use as collateral. But let's see if we can solve this. It's almost 12. Wow. Let's see. Look at question 2. Look at question 2. This question is talking about source of financing. The directors, question 3, sorry. The directors of Kenny's PSC wish to make an equity issue to finance an 800 million expansion scheme with an expected return, with an expected net present value of 110 million. It is also to refinance. It is also to refinance existing 15% term loan of 500 million. And pay off penalty of 35 million for early redemption of the loan. Kenny has obtained approval from its shareholders to suspend their preemptive right. For the company to make 1,500 million placements of shares, which will be at a price of 185 kobo per share. Issue costs are estimated to be 4% of the surplus fund from the issue will be invested in commercial paper, which is currently yielding 9% per annum per year. Kenny's current capital structure is given below. Ordinary shares, the ordinary shares, 25 kobo per shares. Share premium reserves, the term loan, what have you, no problem. The company current share price is 90 kobo. Bond price is 102. Kenny can raise bond or medium-term bank finance at 10% per year. The stock market may be assumed to be semi-strong form efficient. Now I told you, that question you asked is about source of financing. The stock market may be assumed to be semi-strong form efficient, and no information about the proposed uses of funds from the issue to the public. Look at it. That market is semi-strong, meaning that that market, investors have information about past financial results. Investors have information about current financial information. But the investors are not aware what we are planning to do. We want to raise funds. We want to source 1,500 million. But they don't know what we want to do with the money. You want to do placement. Examiner say ignore tax. Now, before you go answer this question, there are some terms here that, before we answer this question, what do you understand by preemptive rights? That was the first question here, sir. Discuss 4 factors, okay? Discuss 4 factors that chemist director should have considered before deciding which form of financing to use. What are directors should have considered before deciding that we are going to use equity finance? Yes, what are these factors? Discuss any 4 factors you think the directors of Kenny's should have considered before deciding on the type of finance to use. I think we mentioned some. One is,
Cost
I'm trying to, so that I put it there because I'm trying to even copy some of these factors so that as I'm discussing, you can also look at it. Yeah, look at it here. We mentioned it. Let me just copy this. Anyone you are able to pick, just hold it for the exam. Because you cannot tell them that if a question on source of finance is tested, you can't say we are not taught. Can't go and they didn't feature in equity. So to requirements A, let me paste. Oh, let me paste this here. Let me see this first. And let me do this. Let me paste using this. One of them is cost. Let me minimize this. Risk, we mentioned it. I will expand, don't worry. You have cost, you have risk, you have control. Market conditions. You have speed. Then you have let me expand this more. Let me expand this more. So please, when you get the material, just try to, although we have discussed it also. And of course, I strongly believe you can develop a story around it too. Number one is cost. If the market is efficient, then the cost paid for any individual financing source will be appropriate for that source. So if you are to finance, what is the cost of equity? What is the cost of debt? Taking into consideration relative risk of alternative sources. The fact that debt finance is normally cheaper than equity does not necessarily mean that debt finance should be choosing. So you are going to consider cost. Number two, the directors must consider risk. The effect of financing upon risk can be measured in several ways. You can do financial gearing. You can calculate interest cover ratios. You can calculate cash flow cover, cash flow ratio. For my student at skills level, we don't know this ratio. You can also calculate the company beta coefficient, the risk of financing. We also have control, the ownership structure of the company shares, and the control of the company. We differ according to the financing method. If you finance with equity, that means you are bringing in more shareholders. That might distort ownership structure. Market conditions. If the share price are falling, what is the market condition? If your company share price are falling, it does not make sense to issue more shares. In that case, equity financing will not be correct. In that case, equity financing does not make sense. If interest rates are expected to fall, therefore, a fixed rate debt might not be wise. If I want to finance my business with debt, I must even ask myself, am I going to take fixed rate debt or floating rate debt? We explain this under interest rate risk. Speed of financing. Please, you can go through this. Flexibility. You can explain any fault to the examiner. Look at requirements B. Explain what is meant by preemptive rights and discuss their advantages and disadvantages. This is what I'm always trying to tell students. Look at all these questions now. Number 1 is 4 marks. Part A is 4 marks. Part B is 6 marks. These are theories. What is preemptive rights? What are the advantages and disadvantages? Your preemptive rights, the legal right of existing shareholders to buy new shares before offering this to the public. When you have preemptive clause, preemptive right, it means that if the company wants to issue new shares, the existing shareholders must be consulted first. They must be given the privilege to buy the share first. Preemptive rights. Under maybe companies law, when it comes to publicly quoted companies, at any point in time the company wants to issue new shares, the shares will be given to the existing shareholder first. It is only when they say they don't want to buy, you cannot issue it to the public. You know why? Because they are the existing owners. Before you can bring in new owners to the business, the existing owner must agree to bring new owners. So preemptive rights is the legal rights of existing shareholders to buy new shares before offering the new shares to the outsiders. It is meant to prevent dilution. And look, if you go and issue new shares to outsiders, that can dilute our ownership structure. The new investors can come in and now control the business more than we, the existing investors. Let me give you this solution. I might not be able to finish all the question, no. Because of time and because of the fact that my system is even getting low. So I've been running on Gen since morning. They refuse to give us slides. People in government. Where's my page, Jerry?
Tell your people to vote wisely this time around.
Are you not part of my people? You deny me.
I'm going to vote wisely, like 10 other people.
You are denying me now. Okay. Let me copy this thing, finish. But now I don't even like owning Gen like this because all the neighbors said, you're disturbing other people too. You want to rest on Saturday, you are now blowing Gen. Blah, blah, blah. But what do we do now? What can we do? the people in government, they are in government. So we don't know whether their member is on this platform. So you have to be careful. Pelumi.
Sir, I just said vote wisely. I did not intend anything.
And I'm going to report you.
I was careful with my words.
Yeah, member might be there.
I don't think vote wisely is anything incriminating. Of course, everybody has to vote
Yes, I agree
wisely.
with you.
I'm supporting Pelumi.
Yeah, I agree with you that yes, there is no implicative message.
Sir, in the classroom, you are a very good teacher, but this time we will not vote for you.
Me, am I contesting?
Sir, that is Mr. Asiwaju. You are the one that is our president now. We are not going to vote for you, sir.
Usman, you are now making it another thing. No, let us do our thoughts and do.
That I get what you did there.
Mr. Asiwaju, you did not do well. Oh. We are not going to vote for you. But in equity, you are our number one.
Please let me do my class. So I don't want to record that one here. All right, let's look at this. I'm trying to do okay. At least we can discuss this because this exam they can even bring theory or two. Can't predict what they will do. Government is trying. It's not easy. You to go and become. If it's there, you become part of government. You know that it's not easy. All right, look at it. Preemptive right means that the company wishes to make a further issue of equity shares for cash must first offer these shares to existing shareholders. So that's it. Before you can issue new shares to the public, you must first issue to your existing shareholders. It is only when they say they don't want to buy, you can now issue to the public. What are the benefits? It allows shareholders to maintain certain percentage of holdings in the company. So you can prevent dilution. This might be particularly important to companies that are controlled by a few investors. Alternative forms of share issue might have to be made at a lower price than a right issue in order to attract new investors. If preemptive right did not exist, I don't know what you're talking about. But one benefit I know very well is that it is used to prevent dilution in ownership. What are the disadvantages? They are a form of restrictive practice that is not appropriate in modern stock market. It's a form of distortion. You are forcing the company to issue shares. It's a form of you are distorting the market forces. You know, when we say a completely market economy, we don't expect any distortion. Then number 2 limitation. Companies can raise finance more quickly and more cheaply when preemptive rights do not exist. You can quickly issue your share. You can do placement. What is placement? Do we know the meaning of placement? Hello guys, Pelumi, what is placement? Is Pelumi here? I'm not sure. What is placement?
Mr. Ashwad, what did you say? Sorry, I'm here. I stepped away from my system briefly.
What is placement? Private placement.
Issue of shares to like small number of investors, like institutional investors, if I remember correctly.
Okay, that's
To
fine. You know I'm calling you.
To raise amount, a small amount of finance.
Oh, that's fine. That's fine. There are 3 ways company can issue new shares to raise cash. There are 3 ways company can issue new shares for the purpose of raising additional finance. You can do public offer. That is offer for public subscription. You are issuing new shares to the general public. A public offer. This is the issuing of new shares to the general investing public. And please note, only publicly quoted companies can do public offer. Only publicly quoted companies can do public offer. We now have private placement. That is placement. This is the issuing of new shares to a relatively small number of selected investors, usually institutional investors. When you are talking of placing, the company will not advertise selling shares in the media. Newspaper, no advertisement. Television, no advertisement. The new shares will be placed privately with a particular stockbroker or a particular issuing house. It is the stockbroker that will look for buyer. Placement is used to reduce cost of issuing, but it can give rise to dilution because your new shares, the new shares may be purchased by one investor. All the new shares may be purchased by one person. And that will affect, or that can affect, ownership structure. All right. Okay, let's see. Now, requirement C. Estimate Kenny's expected share price. Once full details of the placements and the use to which the finance is to be put are announced. What the examiner is asking you is this. Currently, we know the share price at the stock market. For this company, the current share price is 190 kobo at the stock market. We now want to issue new shares under placement. We want to issue new shares under placement. If you issue new shares, that means number of the company shares will increase at the stock market. If you issue new shares, that means number of the company shares will increase at the stock market. If number of shares should increase, there is the possibility that the share price will fall. If the number of shares should increase, there is a possibility that the share price may fall. Examiner is now asking you, if we announce placement, that is, we want to issue new shares to a selected number of new investors, we are going to issue the shares at 185 kobo. We need to generate 1,500 million. Now, what is the share price after the completion of the placement? Like I said, I don't know if I'm able to finish it. My system is blinking, but I'll try. Let me copy this to make it faster. But we have to do small workings here. Requirement C now. Let me try and finish this. Oh. Okay. The first comment. In a semi-strong market, the share price should accurately reflect new relevant information when it becomes publicly available. Once the information is made public, the share price will change. This will include the effect on Kenny's of the expansion scheme and the redemption of the term loan. Let's go to it. First, determine the value of the existing shares. First working. This is in million. Value of existing shares. Now go and check. How many shares do we have? 50 kobo per share. Total amount 800 million. Please, how many shares do we have currently? 800 divided by 0.25. Where's my calculator, sir?
3,200.
Okay, thank you. First, we have how many shares? We have 3,200 shares currently. And the examiner says the company's current share price is 190. Come here. Value of the existing shares. We have 3,200 shares. Price per share, that is market price now. 190 kobo. That is 1 naira in naira now. 1 naira 90 kobo. Please multiply. What is the value of the existing shares? multiply by 1.9.
6,080.
Thank you. Our existing shares, 6,080 million. That's our existing shares. Now, what is the return from the new project? NPV of new projects. That will increase our value. Remember NPV. Your NPV, net present value, increases the wealth of the shareholders. Is that not, please? NPV of new projects. That net present value will increase wealth of the shareholder. What we call wealth of the shareholder is the value of the investment at the stock market. Currently, the value of our existing shares is 6,080. We now invest in new projects. That new project will give us a positive NPV. Go back to the question. Examiner says, directors of Kenny PSC wishes to make an equity issue to finance an 800 million expansion scheme with an expected net present value of 110. This will increase value of the shareholders 110. Next, how much are we going to generate from the new shares? Proceeds of new issue. Proceed of new issue. Examiner gave us. Look at it here. Where is this? Yeah, look at it. For the company to make 1,500 placement of new shares, we are going to issue new shares to generate 1,500 million. Pick that. $1,500. What next? Issue cost. We have to work this. We are going to incur cost of issuing this. Let's go to it. Issue cost. Our issue cost. Examiner say 4%. Let's go and explain this. Look at it here. Yeah, look at it. The placement of shares which will be issued at 185 kobo per shares. Issue cost are estimated to be 4% of the gross proceed. Please compute 4% of 1,500. The gross proceed we are going to get. What do you have?
60.
This is 60. We are going to incur issue cost. What other things now? Now let's look at other things that will affect this investment. One is, if you generate this money, our plan is to repay our term loan, one of our plans. Look at it here. Let me label this. Avoidable future cash flows. Avoidable future cash flow. This is relevant to me. Look at it here, please. And look at these comments. When we generate this money, we want to use it to finance two things. We are going to finance the new projects. It is also to finance, to refinance an existing 15% term loan of 500 million and pay off penalty of 35 million for early redemption of the loan. Let me explain this. By the time you do your placements, you issue new shares to investors, you are going to generate 1,500 million. Out of this money, you are going to finance new project expansion, 800 million. Now, out of this money, you are going to repay your debt. Now, the question is, if you repay your debt, what happened to your interest payments? Hello? If you repay your debt, what is the debt? The term loan. This term loan will be repaid. Now the question is, if you repay this loan, what happens to your interest payments? Let me hear from this class.
It will reduce.
You are no longer to, thank you. You are no longer going to pay interest on that again. You are going to have interest saved. We come here. Something is missing here. This is for 5 years. This is to be repaid in 5 years. It's missing. That means if I repay the loan today, I'm going to save interest payment. Interest in year 1 will be saved. Interest in year 2 will be saved. Interest in year 3 will be saved. Interest in year 4 will be saved. You now go and calculate annual interest saved. You come here, 15% of 500 million. You come here. Interest saved. 15% of 500 million. If you calculate, you are going to get. No, speak up, don't worry, tell me. 75 million annually. Ew. Please, I don't intend to shut down the class, but my system might shut down. Oh. If I have to drive out to go and buy fuel now, that will be in the evening. My system might shut down. So if it happens, please pardon me. But what you are going to do here is from year 1 to year 5, you have annual interest saved 75 million. You now need to look for the present value. That is what? Annuity now. Year 1 to year 5. Year 1, I'm going to save 75 million. Year 2, 75 million. Year 3, 75 million. Year 4, 75 million. Examiner now told us in the question. Examiner said something again. What discount rate are we going to use? Examiner now says something here. He said, look at it. Kenis can issue bond or medium-term bank finance at 10%. The current borrowing rate is 10%. That is the appropriate discount rate. Calculate annuity factor at 10% for 5 years. Calculate annuity factor at 10% for 5 years. If you calculate correctly, you are going to get 3.791. So if you come here, multiply by 3.791, that will give you the present value of annual interest saved. I have 284.325. 284.325. So by repaying your debt, you save the interest payment. The debt should have been repaid in 5 years, but we are repaying now 284.325. Again, you are redeeming the debt now. You are repaying the money now. Ordinarily, you are supposed to repay the money in 5 years. Ordinarily, this debt is supposed to be repaid in 5 years. That means in 5 years' time, I'm going to avoid payment now. What is the present value of the money redeemed now? Future cash flow avoided. By doing placements and repaying my debt now, I will avoid paying 500 million in 5 years' time. Look at avoided future cash flows. This is one. Number two, redemption value. That means by borrowing money, by issuing new shares under placement, redemption value is avoided in 5 years. I should have paid 500 million in 5 years. I should have paid 500 million in 5 years. But I'm paying the money now. That means I will avoid paying in the future. That means I will avoid what? Paying in the future. You now ask yourself, the money I should have paid in 5 years' time, I'm avoiding it. What is the present value now? You now go and calculate present value, that is 5-year discount factor at 10%. If you calculate, it's time to pray. I've been talking for almost 4 hours. Wow. Okay, we'll round up now. I have 0.621. That is discount factor at 10% year 5. The money I should have paid in 5 years' time, 500 million, I've avoided this by taking a decision to issue new shares and repay the money now. This future cash flows is avoided. 500 million multiplied by 0.621. I have 310.5. What other things? Cost of redemption. I must repay the money now. Look at it. This is now. Cost of redemption now. 500 million in brackets. Then penalty. For paying the debt now, I'm supposed to pay the debt now. Examiner says if you pay the debt early, you are going to incur penalty. Penalty charge 35 million in bracket. Now you have taken all the variables. All this information has become known to the market. Under efficient capital. Sorry, let me shut down my distance. Let me shut down the class appropriately. So you can check 2023, I think May dies. Yes, you can check it for the complete. We're almost done, but I want to make sure I shut down properly. So thank you for your time. That's how best we can go. You can check the video on dividend policy to learn more. All right, let's have a blessed afternoon. I'm checking out.